Joining me now to discuss where he's finding opportunity in this current market environment is Joseph Amato, Neuberger Berman's President and Chief Investment Officer. Joe, it's great to have you back on the show. I'm going to start right there with you because we saw the 10-year Treasury yield move higher today. And even as that has been happening here, we've had this run up in the last couple of weeks. Stocks have been hanging in there. They've been very resilient. Is this a dynamic that can continue?
I think it can, because I think rates are moving up for what one might say are the right reasons. Your rates have moved up because the economy has proven to be a bit stronger. And so the question is whether you're going to move into a period of higher nominal growth. Growth at the beginning of the quarter, the consensus was probably for 1% growth in the U.S. economy. And by now, you're probably going to be at 2 to 2.5% for the first quarter. So that combined with where inflation is, gives you a pretty decent nominal growth environment, which, again, should push rates higher for, again, what we think are the right reasons.
Okay. How real, though, is the risk that you see inflation push higher or even just stay really sticky at these current levels if the economy continues to stay as strong as it is?
We think it's a fair risk in the sense that, a lot of the forces driving the economy are going to keep wage rates up higher, which is one of the key components of why inflation's been a bit higher. So, our sense is by the fourth quarter of this year, you're going to be in the 2.5% range. So we think the direction of travel is still pretty clear with respect to inflation, but it's probably going to be coming down a bit slower than one would have expected. And that's one of the reasons why that the market is now assuming that maybe you get 2 rate cuts this year, not 3, which is actually where the Fed is in its own estimates.
Okay. So I'm looking at my notes here. It says you're neutral overall on equities, but overweight on U.S. small and medium-sized companies. Why, and how does that speak to the broadening out of the rally that we have seen here?
Well, I think the rally is going to broaden out even further. I mean, if the economy is, in fact, moving up for a higher level of growth, small caps should do well. Small caps have generally underperformed large caps over the course of the last number of years. The relative valuations are as wide as we've seen in a long, long time. And a stronger U.S. economy will drive higher levels of growth for small caps. And, we're very excited about that. Generally, we're overweight U.S. And the other place that we're excited about is in Japan, where I think there's a lot of good things going on from a corporate governance standpoint. So those are 2 areas that we're overweight.
Okay. I do want to shift gears here because we've seen this very active proxy season playing out. There's been a lot of activist investor pressure across a number of names. Disney, definitely the most high profile last week. Neuberger Berman supported Trian and Nelson Peltz in that proxy fight. Also, and I realize it's just a small position in Norfolk Southern, but saying on Friday it would support Ancora in that activist investors' fight against the CEO and the board there. Break it down for me. Why?
Well, we take our role as an owner very, very seriously. So we get deeply engaged with companies and where we think it's important for either progress to be made, whether it relates to a succession plan in the context of the Disney situation or other corporate issues. And that's, I think, one of the roles that is critical for active managers to play. One of the dynamics you've seen in U.S. corporate governance is with passive ownership in companies approaching 30, 40% in some cases, the dynamics with your shareholder base changes quite dramatically, right? Which is an interesting contrast. If you see, I referenced Japan earlier, like Japan's moving in a more constructive direction from a corporate governance standpoint, right? They're taking their shareholders more seriously. They're pushing for higher returns on equity. Whereas in the U.S., you're almost going in the opposite direction because of the passive ownership. And so, we feel strongly about something. We're going to step up and be counted. And in the case of Disney, we felt that the succession plan had not been executed particularly well last time. And with essentially the same board, we felt a set of independent eyes and ears would be helpful for that process. In this case, we were wrong as it relates to the vote. But, we certainly hope the board gets it right this time.